Welcome to the 6-5 podcast. I'm your host today, Daniel Newman, Principal Analyst, Futurum Research. Back after a 3-week hiatus. I'll let Pat decide whether he wants to share those details or not after the new year kicked off. We missed you all. Today is Earningspalooza. And as you know, the big wave of earnings in tech have gone on past few weeks. Been busy covering them. Lots to talk about. Before we jump into the show, Patrick, excited to be back, man.
Yeah, great to be back. I had a little bout of COVID that I am still recovering from, but it's been about 2 weeks back in the saddle. Knocked me out pretty much cold for 5 days. Ended up getting an antibody treatment, and I was on a parabolic rise after that. But I can tell you that it is definitely real. You do not want to catch it. I am an old guy. I'm 53. So my son was over it in about 2 days, and he was fine, ready to get out of the house in 3. But take care of yourself out there. But I'm just glad to be back for some earnings palooza. But before we dive in, we do have to remind you that this podcast is for information and entertainment purposes only. Don't take what we say and trade. That would be dumb. In fact, just do the opposite of what we are inclined to talk about.
Yeah, and in fairness, don't do anything. Don't do the opposite. Just listen, enjoy, and know that Patrick and I are in practice industry analysts that do follow and track closely what is going on with these companies. Try to take a perspective beyond just the numbers. Try to give you a little bit of depth. Today, we're going to cover 6. There was more than 6, but this is the 6-5. So we handpicked 6 tech earnings that took place over the last couple of weeks. We're going to talk Microsoft, AMD, Intel, Amazon, Qualcomm, and Google. And I believe we're going to try to do them in that order. And that's the fancy fun part, Pat, of working with you now and doing these banners that you do is so much more information for the live viewer. And by the way, thanks everyone for tuning in. We always appreciate it. We love our community. We hope that you've stood by us. We won't take many 3-week hiatuses, but we were laughing earlier about what's going to happen when we have to start traveling again. And we can't just be at home every day. Every time our inclination to go online and record comes, can we really even do that? So, hey, let's get started, Pat. Let's get started, Pat.
Sounds good.
Microsoft. I've been talking a lot. You want to kick it off?
Yeah, let's kick this off. So Microsoft has really been on a tear lately. They're in the $1.x trillion club, and they blew the doors off this as well. You can go from left to right on this fancy infographic here. Productive and business processes double digit, intelligent and cloud, which includes Azure, up 22%. More personal computing, which is all about Windows, Surface, as Xbox, up big as well to round out a total of 15%. Some really interesting things. Azure was really on the move. I believe that they were up 50%. And if you can think about that for a second, Azure being up 50% and such a massive business is truly astounding, and I think a testament to what they're doing, particularly on the PaaS side of the equation. Just like the last 6 or 7 quarters, everything that's 365 was up very impressive, deep double digits. Whether it was Office 365, Dynamics 365, all around a solid performance. The only thing that I had some question on was Surface that went up 3% in a market that went up over 20%. I did some digging around, and their units were actually quite respectable. But what happened is their ASP went down. Which again, interesting. Microsoft is entering some new price points, but I'm sure they didn't do that in order to sacrifice some of the higher price points out there.
Yeah, that caught my attention too in my coverage. I wrote a piece on Market Watch immediately following look, the momentum for Microsoft going into the new year is very well placed. It will be very difficult to knock it off the rails. The cloud conversion is going well. The Power Platform has unbelievable stability, and there's a ton of interest around the tying together the applications layer to the infrastructure layer. Been very impressed by the growth in Azure. I would still love to see an infrastructure breakout at some point. It would be very interesting to get our eyeballs on.
Yeah.
But, I've been very overall feeling good about it. I think we saw productivity grew 13%. Office continues to rise. An area to note, Pat, not Power Platform, Dynamics 365, the cloud-based ERP and CRM is growing 39%. Again, that's about the same as last quarter. And that's a really big number that is outpacing just ever so slightly the biggest, baddest company in that space, which is Salesforce. Teams continues to grow. The company launched a new employee engagement platform today called Viva that is going to not only focus on the teams and the collaboration side, but actually focus on learning and continued development of employees. So it's going to be interesting to sort of watch what happened there. And Pat, the last thing that I really had of note was gaming has just been outstanding.
Yeah, for sure.
Over 50% overall growth and 40% on the subscription side to the online gaming, which is kind of why I don't know why GameStop is worth so much ever, because this is the real trend when it comes to gaming. It's moving it more online. It's making it remote, accessible, on demand. So a lot of strong areas. To your point, Pat, I am kind of curious about what happened with Surface. I've been very bullish on Surface. That number was a little soft for my liking, especially given the overall growth of the PC. Mac saw big growth. The overall Dell, HP all saw big growth. So that's going to be something to keep an eye on. But I still think the company has a really good position in ultra premium. So let's jump to the next one. AMD, Pat. This I know you love AMD. I love to talk about AMD. So let's talk AMD. And for everyone out there, Pat was one of the youngest VPs in AMD history. It's an unknown fact maybe to some of our 6'5" community, but this was back when you were my age.
Yeah, it's kind of crazy. I mean, it was almost a decade ago, but I was a corporate vice president at AMD, ran product marketing, product management, ran channel marketing, created the first global channel marketing group, and ran corporate strategy for client devices. But let's jump into AMD. AMD had a phenomenal 2020, as you can see, increasing 45%. I mean, it's hard for me to find any weaknesses in the year and in the quarter. I think everybody would have liked a little bit more epic. But they gained a tremendous amount of market share in notebooks, and they gained a tremendous amount of market share in desktops. That doesn't mean that they didn't gain market share in servers. They did. It was just a lot more pronounced. Let's move into the quarter here. Again, deep double-digit, 53% growth in the fourth quarter here. Also, not only hitting the canvas off the ball with revenue, but also in profitability. Look at the gains in profitability that they had. Just incredible. Cash flow. I mean, this is a company that's hitting on all cylinders right now. At this point, by the way, I will add, Intel did claw back some client market share for the quarter, but overall, AMD was up around 6 points. I think moving into 2021, AMD has got to get more supply. AMD can sell more. They just can't supply it because of the shortcomings at TSMC. What I do expect is a little better management cross vendor between TSMC and Samsung. I think maybe even AMD was surprised at the level of success they had, and just didn't plan ahead as much as I think they could have.
It's a good point. And when we talk about Qualcomm, there's going to be a similar discussion there. It seems right now that chips are eating the world. We've been saying that for a year. It's not going to change in 2021. But the companies that are fabless or that are limited in terms of internal production and dependent completely on external fabs are seeing some headwinds in terms of the ability to meet demand, which is a great sign. Demand planning is not necessarily something that was failed upon, but the actual demand was better than these companies even expected, which is something very, very promising. Pat, you hit the numbers pretty well. I did want to touch on the Mercury research data that recently came out. It did show Intel for the first time, I think, in 8 quarters, showing a slight recapture of market share. But overall, I mean, it was an absolute blowout year for AMD. I mean, the earnings were well above year over year for the year, for the quarter over quarter. The revenue is up substantially. And by the way, the interesting thing about the year over year, Pat, is, I've been critical, written a number of Market Watch pieces criticizing the sometimes as high as 160 times trailing earnings that AMD's price action has seen. But based upon its earnings this year, which I think came in a little over $1.20 a share for the full year, they're starting to get more in line with where these highly valued tech stocks are, 40 to 50 times. I know it's a little technical on the equity side. We're industry guys, but that stuff, I like that stuff. Values getting in line. The other thing, Pat, that I really do think, we need to pay attention to is the EPIC side of the business and the kind of ongoing saga with the NVIDIA. The x86 landscape as a whole is going to have to pay attention next year. You've got M1, you've got what's going on with NVIDIA ARM and more companies making variants of PCs. And so not only will it be AMD competing with Intel, but it's going to be a whole new set of players if that deal gets done, which new headwinds with EU scrutiny today. Now, as a part of our live element, we've been bringing in external questions. So, we had one that just popped up on the screen. Love to address it really quickly from Tom Price. He said, should AMD be concerned about current tensions among China, Taiwan, and U.S. since TSMC is their primary fab? I touched on this with Qualcomm, but Pat, I'll let you touch on this for AMD.
Yeah, I think they should be, and they are, just like NVIDIA is in the same spot, or Xilinx, who's very heavily weighted to TSMC. We've seen TSMC make, I would say, a slight move in Arizona with a fab they're building there. And for everything I understand is that Samsung is planning on building a leading edge 3 nanometer facility in Austin, Texas. So short answer is yes. And if Intel were delivering as scheduled, I don't think there would be as much discussion about this, especially with the dialogue about this notion of Intel getting out of fab, splitting it from design, and letting everybody get access to their fabs. And we can maybe touch on that when we talk about AMD. But thanks for the question, Tom.
Yeah. So speaking of Intel, let's jump over there, Pat. Intel had a kind of a turbulent few weeks,
to say the least.
First of all, lots of pressure going back to the David Loeb and the activist investor moment. And then you had a CEO transition get announced, and then earnings came right after. But here's the thing, is the company as a whole, there's a little bit of a detachment between the sentiment and the actual financial performance of the company.
I mean, they crushed it. I mean, they crushed it in the quarter. And I brought that out, and I just got destroyed on Twitter for it. But hey, from a revenue and an EPS standpoint, they crushed it. So
good.
Yeah.
Beat on revenue by a lot, 20 billion versus 17.5. Beat on earnings, $1.52 versus $1.10. Their forecast is an 18.6 billion forecast, $1.03 earnings in the first quarter. And the overall sentiment, though, has just been so troubling. And
Yeah,
I think we're at a inflection point for the company. And I want to say that they're starting to get what they need together in order to move. I think the Swan tenure is going to be looked at more negatively than it should be. I think he did a nice job of pivoting from BK, solving some of the big problems, reshaping. But I do think it's the right moment now for this transition. Pat comes back as a former first CTO of Intel, a guy that's well respected in the halls of the company. The company's somewhat been struggling to overcome a number of production challenges, some say innovation challenges. You've seen them exit some businesses that were expected to be successes, the 5G mobile business, the NAND business. But I also look at that as strategic in tightening up the ship and getting more in line, focusing on the data-centric strategy, offering more than a $300 billion TAM for the company, and recommitting itself to this notebook space, to the next generation of connected 5G. And then, of course, the company's made some real, strides in network, 5G service provider, as well as automotive. And that was all reflected, Pat, in this quarter's results. There was some ups, some down, but PC-centric was up, data-centric was down. But Pat, the first 2 quarters of the year, data-centric destroyed expectations, such big numbers that it set the whole year up. So this was a record revenue 2020 for Intel. And I'm just a little exhausted dealing with the emotional instability of the market at times versus the reality. Look, AMD's done a good job. NVIDIA's done a good job. Other players are definitely making Intel work harder, but this is not a company that is down and out. This is not Kodak or BlackBerry in the waning hours of its existence. This is a company that legitimately, if it can fix its manufacturing woes, and I think it will, and if it can come out with a few innovative products, I think it's in really good shape. And in fact, sometimes I think the companies we're most afraid of being the competitors aren't nearly as scary as some of their biggest partners right now, being the Amazons and Microsofts that are actually becoming some of the biggest, juggernauts when it comes to IT advancement. But overall, a very good year, a very good quarter.
Yeah, so let me fill in just some what you talked about. I think what really spooked people was this precipitous decline of DCG Group. I mean, you can see the numbers right there. It was a pretty hard fall. Now, the big difference here is that they had some really tough comparisons a year ago where they just knocked the cover off the ball. And then when you dig in, a typical area of strength for Intel has always been cloud SP. For it to be down 15%. Now you got to balance that. It was up 20% for the entire year, but it spooked people. The other thing that spooked investors was the uncertainty around where Intel is going to make its parts. Intel had a commitment that said by the end of January, they were going to tell people, give people more granularity, and they didn't. Now, I understand it from an Intel point of view. You have a new CEO, and Pat Gelsinger has to get time in there to do that. By the way, you may not know this, but Pat Gelsinger left under kind of a cloud of losing market share to AMD years ago, and I'm sure he's looking for some payback against AMD. Some interesting stuff did come up on the call, though. They did talk about increasing market share in PCs. The interesting point is it was lower margin business, which is usually a twist from what they normally trade barbs with AMD. Gelsinger did say the majority of 2023 products will be manufactured internally, and they likely will expand the use of external foundries. No question. They already use external foundries, but I believe these are going to be for some compute and also likely some graphics product. I was pleased to see that they're qualifying Alder Lake desktops and notebooks for production. Foveros and a 3D type of packaging was supposed to do some big stuff. I don't think the first out impressed many folks on performance or power. So I think it's up for Intel to impress people with Alder Lake. But I think we've beat this one in here a lot. We talk about Intel a lot. It's a very important company. Not only to the technology industry, but also to the defense and sovereignty of the United States. So it's going to be, we're going to keep talking about it a lot.
I've been all over the place talking Intel, a lot of questions about it. It's the semiconductor space is, like you said, a matter of so many things beyond just the computers we use every day, big national security, big economy play too. And as we're trying to bounce back from the last year, Pat, Amazon, goodness, I don't even know what to say. So a little backstory: the Amazon and Alphabet earnings came out the same day. I had a number of press calls about these Alphabet cloud numbers, which we'll talk about a little bit later. And it was really funny because I got these calls, and then 10 minutes later, the Bezos news dropped, and it was like the world stopped. So, we'll talk real quick about the numbers here, Pat, but I think what everyone's going to want to hear is your take on what's going on with Bezos' departure, Andy Jassy being named new CEO. But just first and foremost, Amazon, $125.56 billion in the quarter. Okay. This is a massive beat. And by the way, the first time the company actually hit over 100 billion in revenue in a single quarter. Big moment, again, got sort of usurped by other news that happened to come out from Amazon. Again, the earnings were just off the charts, over $14 a share versus a number about half that, $7.23. So, my immediate take, Pat, and, this was my commentary, whether it was on TV, whether it was on my research note, this earnings report, while great stuff, AWS grew 28%. That was considered a bad number because I think they were looking for like 29%.
Yeah.
Would have been estimated. But look, across the board, the results are good. Amazon's in a really good place. AWS is in a really good place. But the attention was all about Jeff Bezos. And I had a lot of chances to weigh in on this, Pat, but I'll give you the first stab at the Bezos Jassy discussion.
Sure. Listen, I do want to come back to the AWS discussion because I think it's important, if you don't mind.
Sure.
I just to put things into perspective. I know people like to focus on percentage growth, which I understand, but when you get to a certain number, that percentage growth does mean a little bit less, in my opinion. And when I look at how much AWS grew cloud revenue, it was they grew it $2.79 billion in the quarter, and they grew it $10 billion dollars to a $55 billion run rate, and delivered over 50% of the entire company's operating income, albeit at a smaller piece. And I think that's phenomenal. Should never get overlooked. I mean, sometimes we get fixated on percentage because it's easy, but we also know that to a certain percentage, I think that AWS might want to break out some of its fastest growing products. My guess is machine learning is a massive growth engine for them. Data analytics, that would be 70, 80, 90% year on year quarterly growth.
Yeah.
But on to Bezos. I mean, first of all, I don't think they could have picked a better person with Andy Jassy. He's incredible. I had the chance to meet him just once, but he's just such a no BS guy. 1 year, don't ask me why I did this, but I listened to 6 straight years of AWS reInvent, and the guy is so consistent. He is so customer focused, and I don't mean BS customer focused. I hear that word customer focused, and I yawn and I get bored. But this company really is building products for their customers. They're fact driven, and given that Andy Jassy was at the company almost as long as Jeff Bezos, I mean, they're kind of, I wouldn't call them two peas in a pod. Jeff's worth 1,000 times more than Andy, but it's not all about money. It's also about being there and being part of the culture. And I think Andy is almost as much about the culture as Jeff Bezos was. So I have confidence in it. Andy is going to have to think more and more about the softer side of the business, the factories that are out there. He's going to have to get involved in all of these nasty investigations that are out there. And that reminds me, while all this is going on and they're crushing it business-wise, Amazon created 400,000 jobs in 2020, and most of that was driven in terms of SMB, whether it's warehouse space or SMB sales. They not only crush it on that vector, but also on the the good neighbor variable as well.
Yeah, Pat. First of all, what you mentioned about AWS, I call it the law of large numbers. The growth is staggering. In terms of the Bezos thing, you kind of hit everything that I said on the head. It's going to be interesting. Jassy has earned this opportunity with the contributions that AWS has given to the overall bottom line of Amazon. In fact, it's many times propped up the overall company in a big way. That big $14 versus $7 beat has a lot to do with the contributions being made by AWS. One of the biggest kind of insider, things that rolls around about Jassy versus Bezos is Jassy's very hands-on. In the halls, they kind of talk about, he still looks at every press release that goes out, very conscious of, what the company is, every new product. He's, very visible. Jeff has been much more of that sort of prolific brainchild that's kind of up in the turret, leading by example, but not necessarily by being in on every single little detail. So that pivot, seeing how he pivots to handle all that daily interaction, becoming a little bit more of that, that profile of the guy, not just leading the 12 billion a quarter, but the 125 billion a quarter overall Amazon. And as you mentioned it, the company gets a lot of grief for things it does, but it's been a big corporate citizen, especially in 2020, whether it was vaccine support, housing and HUD and urban development support. The company's been very involved in job creation, minimum wage support, sustainability. And yes, companies do ESG with the intention of improving their brand reputation, but that shouldn't be soured upon. We want companies that feel a commitment to give back to the society and to do more to help the communities. All right, let's jump into the next topic here. Pat, we have on deck Qualcomm. This is the freshest of the bunch.
Yeah, so Qualcomm comes out and absolutely nails it, and then the market turns around and cuts them by 10%. So it was a little bit of a weird one in that they delivered on everything in line with at least what I thought earnings and EPS expectations were, and then they just got absolutely hammered. Some of the highlights that were on top for me were, I love their big growth numbers. I mean, they're amazing. 63% growth in revenue, net income up 118%, EPS was up 119%. And really on the back primarily of 5G, but Qualcomm is no longer a one-hit wonder on handsets. They also announced that two of their ancillary businesses, RF front end and IoT, were in themselves billion-dollar businesses for the quarter. And I think, there's a couple of financial analysts who don't quite understand what Qualcomm was doing in RFFE, but Qualcomm pretty much put to bed that they have the largest mobile RFFE business over Broadcom, over Qorvo, and over Skyworks. And then I need to parse a little bit of that IoT business at $1 billion, but I believe that is bigger than some pure play IoT businesses. And then finally, that $200 million automotive is actually bigger than NVIDIA's. And I need to get some more comps out of that. The biggest what's next about the stock, I think, is how can they take advantage of Huawei's decline, whether it's selling off Honor, where Qualcomm has access to all that, but also the Huawei brand shift for an Oppo, and even Qualcomm benefits when Apple comes in and takes share. They benefit when Samsung comes in many countries, not all countries. So there's just a tremendous amount of upside for this stock, and I can't quite explain to you why. Where did it end up? Off 14% today or something?
Yeah, it saw a big hit today, Pat, and I'll just touch on a couple of things. The QCT business that you mentioned grew 81% year over year. 63% was overall number, including that very, very lucrative licensing business that also, by the way, was up on an annualized basis. So there really wasn't a down. I mean, the number and the expectation of the market was somewhat high. And as you and I had the chance to get briefed by Cristiano, the incoming CEO, and Steve Mollenkopf, both of them seem very confident that if TSM can meet demand, the revenue numbers will follow. So I just didn't feel there was that much to be negative about. If I could point to the Citigroup downgrade, it was absurd to me. Listen, their equities analysts at times nail it. And when it comes to the fundamentals, I certainly believe they do a great job of reading the spreadsheets. What gets missed sometimes is the context, right? There's a business here, and that's what we're trying to do here is tie these two things together. Yeah. The claim in the Citi research note, Pat, was that we're late in the 5G cycle, which was where in Qualcomm's experience during the 4G cycle, later on, margins started compressing on devices. There's no indication at this point that we are late in the 5G cycle. In fact, last year, I think there was somewhere around 225 million handsets that Qualcomm's technology was provided. They're estimating closer to 500 million this year. There are billions of 5G devices. And the other thing that's being missed by that particular research is 5G is going to have an implication on a lot more than just handsets. You're talking about connected PCs. You're talking about smart cities. You're talking about vehicles. You're talking about fixed 5G networks. You're talking about data centers. There are so many more places where 5G technology is going to be important, and it's going to connect to this broader ecosystem. So you look at 40% growth in all the adjacencies. You look at massive growth that's going to continue to exist in 5G. I'm just not that worried about it. I think the idea that margin compression is going to happen in the near term for Qualcomm is a little bit absurd and unproven. I'd love to see the data that supports that. I believe next quarter, just like this quarter, margins will continue to be stable or even grow, which, by the way, their margins did grow this year. All right, Pat, let's hit the last one.
Good stuff.
So I had a great opportunity on this week on Tuesday to go on Bloomberg and talk to Emily Chang about Alphabet, but it was funny. This is where I was telling you my story earlier about. So I got a call from Josh over. You talked to him, and Josh Lipton, and he was asking me about Google Cloud, and we had this really funny moment because right after he asked me about Google Cloud, the Bezos news came out, and we just kind of laughed. We're like, well, I guess this isn't that big of a thing. So this was the big quarter for Alphabet. So last quarter, Thomas Kurian and and Sundar Pichai and the team said, we're going to, for the first time, break out the Google Cloud number. And by the way, I think you and I would both agree, we love this. We love the transparency. Yeah. We were so happy to see it. Pat, I know you wanted to take this one, so I'm actually going to let you talk a little bit about the number. But overall, this was supposed to be the biggest news of earnings day. Unfortunately, when the CEO of one of the world's trillion-dollar companies steps down, news cycles can change quickly.
Yeah, I mean, to me, the breakout, I mean, first off, very impressive overall number. Google Cloud, $13 billion in 2020. That is a very much a real business. Obviously, the challenge, they have a bunch of challenges. They have to hit growth, because if you compare that Google Cloud number to, let's say, an AWS number, it's quite different. But the bigger challenge is this $5.6 billion loss on the $13 billion is just excessive, in my opinion. And I think there will be need to be some more explanations moving forward. But again, I credit the company with breaking it out, to have the confidence to break it out. They wouldn't break it out if they didn't think that they would be narrowing it, right? Nobody would ever do that. So there's something behind the scenes here of how they're going to be moving that forward.
Yeah, Pat, overall, the service numbers were great. The profitability was great. You know, my exact response to that point is that when you have parts of the business creating such significant net income, right? You look at the income from operations at 15 billion, you can afford to span $1 billion here and $1 billion there on what you'd call bets. Google Cloud isn't just another bet, though. This is a big bet for the company. The growth number is significant. I mean, they're right there around where Azure is. Of course, the growth is bigger than AWS, but the number's not even in the same stratosphere right now. So you have to kind of notate that. It's easier to grow 50% or 40+% when you're 3 billion than 12 billion. You know, Pat, but I think narrowing that loss to a profit is going to be something we're all going to have to be keeping our eye on. This has to become at some point a sustainable business to compete with companies that have sustainable cloud businesses that are continuing to run and innovate and develop new products. But I like your point. Confidence. This was a confidence moment for the company. The company believed it would have a number that impressed. It did grow and almost kept its loss in line. So if it can kind of continue to manage that through the next wave of growth, that means that maybe they're starting to hit that tipping point where the revenues of the near future will actually start to create bigger declines in the losses, eventually taking this to profitability. Last note, remember what Pat and I said, AWS is one of the largest bottom line contributors to Amazon. We have the exact opposite here. Google eats up the earnings. So you have 19 billion or so in profit being created by the advertising business, and then multiple billions of dollars, around $5 billion last year, got eaten up by its cloud endeavors. That needs to turn to give the street confidence. Because right now I still see Google competing more with IBM and Oracle for cloud market than I really see it competing with Azure and AWS. But that's exactly the shift that I believe the company is trying to make.
Yeah, they're really they're still landing and expanding. They get in machine learning and data analytics, which they're known for, and then get more of the, I'll call it pedestrian type of business, raw compute, general compute. But I think Thomas Kurian is focusing on the right things. He is focusing on the right products, and he is rapidly expanding the sales and field team, which was one of Google's biggest issues. If you look at what customers were happy and dissatisfied with at the same time. So, but again, I see this as confidence. We'll have
Absolutely.
to see.
Hey, 38 minutes. Great show, Pat. The Earningspalooza shows are always a lot of fun. I mean, you and I were not equities guys, but I think on the industry side, we do love to tie the equities, the industry, the strategy together. These things are not mutually exclusive. And as you heard us talking about city downgrades, you talk about weird, market shifts, selling pressures. This comes from operational, industry-related, technology-related decisions that these companies are making. So hopefully everyone that was out there had a chance to really garner and gather some insights here.
And I'll reiterate that I watch the earnings because executives can lie less. You get the highest level of truth you're going to get out of any company, and it indicates, let's not kid ourselves in that, board of directors and investors have intense scrutiny on who the leaders are going to be, what the roadmaps look like, and their general satisfaction. I don't think that's right. I'm a product person at my core, but I don't make the rules, Daniel.
Yeah, it's a great point, though. It is the greatest level of transparency. Regulatory bodies frown upon lies being told on earnings calls. So, yeah, it's great stuff, and a great way to wrap up a first show back, and I'm so glad that you're feeling better. You look good, a fresh haircut, fresh shave. It's two things I haven't done yet today. So, everyone out there, thank you so much for sticking with us. Hit that subscribe button. Join us, whether it's on Twitter, LinkedIn, Facebook, YouTube, Apple, or Spotify. We just really appreciate you tuning in. Again, thank you all. We're going to be back. Lots more, so much more to talk about. Pat, good stuff today.
We're out of here.
See you later.